Welcome, everyone. It's my great honor to introduce the first session of our academic track here. We have an exciting program ahead of us, and I'm not going to steal too much time, but I just want to thank, first of all, the PI team, Catherine and Zoe, for their support, and my co-chairs of this conference, which means Pedro Matos, wherever he is, Pedro Matos back in the back, Ayako Yasuda here in the front, and Laura Starks, who cannot be with us, but she was also a big part of this team. So thank you, and I'm going to hand it over to the first presenter. Actually, sorry, not Kelly, apologies. I'm handing over to Martin Skancke. Apologies for this one, for a couple of few words.
Thank you, Caroline. My name is Martin Skancke. I'm chair of the PRI, and I'm really happy to be here at the first session of the Academic Network Conference. So thank you. Caroline and I have something in common in the sense that I'm soon stepping down as chair of the PRI, and Caroline is stepping down as chair of the Academic Network Advisory Committee. So I'll just take this opportunity to thank you, first of all, for everything you've done for the Academic Network, and also the Conference Committee. So Caroline, Laura Starks, Pedro Matos, and Ayako Yasuda, for everything you've done to put this together, and of course everyone participating in the networks. And last but not least, thank the unstoppable Catherine Ng for her efforts in not just organizing this event, but actually being promoter of the Academic Network for many years now. So that's highly appreciated. And I want to say the Academic Network is really important to the PRI. The PRI is about promoting good, responsible investment practices. And I think this interaction between academics and practitioners is really useful, because good, responsible investment practices have to be evidence-based. And I think that the Academic Network and the papers that we're about to be discussing today and tomorrow really provide a lot of useful insights for investors. But conversely, I think the PRI can contribute a lot to the academic world. I think we have a lot of data collected through our reporting and assessment framework and data on engagement. And I think it's the synergies and the fruitful cooperation between actually academics and practitioners can promote responsible investment, make us understand more, learn more, and do better. So that's important. I was asked to also mention the winners of the papers, Best Conference Paper and the Best PhD Paper Award. I asked Catherine, will I be handing them like a giant check or a big diploma? And she said, no, you're just mentioning them. So, but you're the ones who chose a career in academia, so you have yourselves to blame. Anyway, the Best Conference Paper Award, a really interesting paper, will be discussed tomorrow. It's called, Does Paying Passive Managers to Engage Improve ESG Performance? Authored by Marco Becht, Julian Franks, Hideaki Miyajima, and Kazunori Suzuki. Using data from DPIF here in Tokyo, the giant pension fund who outsources their management to external managers. And I think this is really an important issue for investors, for asset owners, to understand how they can incentivize their managers to actually exercise their voting rights and to do engagement. So I think that's a really, really useful piece of research that I think many practitioners will find interesting, and it's being discussed tomorrow. And then today, later today in this session, we'll be discussing another really interesting paper, winner of the Best PhD Paper Award by Matilde Faralli, who's sitting there. Again, really interesting about how extreme weather events affect the expectations of analysts and how that affect analysts' financial forecasts. And I'll be a discussant of that paper later. Looking forward to that. So I wish you all a very fruitful session today and also sessions tomorrow. And I'll hand over to Kelly Shue, who will present the first paper today. Thank you.
All right. Oh, well, thank you very much to the organizers for the opportunity to be here. I'll be presenting joint research with Sam Hartzmark about counterproductive sustainable investing, and we'll introduce this measure of the impact elasticity of brown and green firms. So let's talk about sustainable investing in practice. There's a huge amount of heterogeneity across sustainable investing strategies, but the dominant strategy really just seeks a green transition, okay? So the goal of these sustainable investors is to reduce firm greenhouse gas emissions intensity while minimizing economic disruption and maintaining or perhaps even growing economic output. Okay. Again, there's a lot of heterogeneity, but the dominant strategy has a very simple implementation, which is investors are going to buy green, so that's low emissions firms, and they're going to divest away or underweight in their portfolio brown firms who have high greenhouse gas emissions. Now, alternative, more sophisticated strategies definitely exist, such as engagement or targeted impact investments at green R&D, but these more sophisticated strategies really represent a very small percentage of the estimated approximately $40 trillion globally invested in some way related to ESG or sustainability. Okay. So our paper is going to present a critique of this dominant sustainable investing strategy in its current form. But I just want to clarify very much that my co-author and I are very supportive of sustainable investing goals in general and very optimistic. And further, we are very, very concerned about global climate change. Okay. You wouldn't think that would need clarification in this conference, but just to make sure. Okay. So we're interested in this question of whether sustainable investing is going to achieve its green transition goal. What's the mechanism? Well, sustainable investors hope to make firms more green by changing their cost of capital. The idea is we're going to direct capital toward green firms, which is going to lower their cost of capital. Further, we're going to direct capital away from brown firms, which is going to raise their cost of capital. Okay. So let's suppose that sustainable investing succeeds in changing the cost of capital of green and brown firms under the dominant strategy. Will it actually achieve its green transition goal? Okay. What we argue is that it really depends on each firm's impact elasticity, which is its change in environmental impact after it experiences a change in the cost of capital. And we're going to measure that separately for brown and green firms. So let me just walk you through an example, which is going to give you the intuition for our paper. Okay, so let's consider a typical green firm that is overweighted in the portfolio of sustainable investors. This is Travelers Insurance, an S&P 500 firm in the insurance industry. It has extremely low emissions intensity of only 1 ton per $1 million of revenue. And it has done a lot to cut its emissions intensity over the past 3 years by 40%. This firm also has ambitious long-term goals of becoming net zero by 2030. Now, consider a typical brown firm. This is a firm that is typically underweighted in the portfolios of sustainable investors. This is Martin Marietta Materials. It's another large S&P 500 firm that produces building materials. It has emissions intensity of 1,000 tons per million revenue. So this firm pollutes 1,000 times as much as Travelers Insurance. Okay. This firm has cut its emissions intensity by 12% over a 3-year period. Okay. This sounds much less impressive than a 40% cut, but this is actually much more meaningful for the environment because the firm started out at 1,000 times the amount of pollution. But what I'm going to show you in the data is sustainable investors have so far prioritized rewarding firms that have large percentage cuts in their emissions, even though those firms started out at very close to zero emissions in the first place. Okay. Martin Marietta Materials has more modest long-term goals, and in particular, it talks about how moving toward clean production is something it wants to do, but is very costly upfront, and it takes years for this investment to pay off. Okay. So the dominant sustainable investing strategy is rather simple. It buys firms like Travelers and avoids firms like Martin Marietta. Let's think about what this can actually accomplish. Travelers, as an insurance firm, just cannot get much more green or brown as its cost of capital shifts around. If we were to decrease its cost of capital towards zero, so it can invest in a lot more, what can it possibly do? Well, it could completely eliminate its emissions, which are close to zero in the first place. There's also just no reason to think that Travelers or many of these other green firms that tend to be services firms could, once it gets access to low cost of capital, produce building materials at a lower emissions intensity than a manufacturing firm such as Martin Marietta, nor is this firm likely to conduct green R&D because it's outside of its scope of business, which is insurance. Okay. Now let's consider Martin Marietta Materials. Okay. It really could become much more green or brown as its cost of capital shifts around. If its cost of capital goes down, this is a firm that can now use cheaper access to financing to invest in some of this new green production methods that would pay off in the future. On the other hand, if sustainable investors punish this firm and raise its cost of capital, that effectively makes this firm much more short-termist because it needs other ways to get cash right now. So it now has an incentive to cut corners or double down on existing brown production, which is its way of getting cash right now in order to avoid bankruptcy. Okay. And this could be very costly for the environment because if Martin Marietta just reverses its reduction in emissions over the past 3 years, that amounts to an increase in pollution that is equal to 30 times the annual level of pollution for a firm like Travelers. So what we do in our research is we carry this intuition forward and test it in the data. So first we look at all firms across the past 20 years for which we have emissions data, and we divide that into brown, neutral, or green firms based upon their emissions into quintiles. Okay. What you first notice that brown firms just really are very special. They produce about 1,700 times the total emissions of green firms. Okay. Is this just due to differences in firm size? No. If we look at emissions intensity, so that's emissions per unit of revenue, the average brown firm still has 261 times the emissions intensity of green firms. So this just tells you that green firms really could be left alone. They're kind of a sideshow. They do not pollute very much at all. Efforts really need to be focused on the set of firms that actually pollute. Next, we're going to measure the firm's impact elasticity, which is its change in environmental impact for a unit change in its cost of capital. And we're going to examine how that firm's emissions intensity responds to various shocks to their cost of capital over the past 20 years. For exogenous shocks to the cost of capital, we're going to use variation in dividend demand. So basically over time, some firms have had an influx of investor money due to favoring dividend-paying firms. So that's kind of our exogenous or random shock to the cost of capital. What we show is in the data is that green firms have impact elasticity pretty close to zero. As their cost of capital moves around, their impact on the environment does not change, which is not that surprising because they start out at close to zero emissions. How would an insurance firm pollute a whole lot more or a whole lot less when it starts at zero? Okay. On the other hand, brown firms have impact elasticity that is sharply negative. So basically, they pollute more per unit of capital, per unit of output when their cost of capital goes up. Now, why do brown and green firms have different impact elasticities? So here's our simple story. Let's suppose a brown firm can choose between two types of projects. The first is continue or expand existing brown production, cut corners on pollution abatement efforts. This is a way to get cash right now. Alternatively, the brown firm can switch to new green production. This requires upfront costly capital investment, and it could pay off, but those future payoffs are backloaded. Okay. Now, if we raise the cost of capital for any firm, that is equivalent to raising its discount rate. Okay, which means it's going to value cash more now relative to cash in the future. So short-term cash flows are going to look more attractive, which is going to favor option one, leading to a negative impact elasticity. So you can think of our paper as pointing to basically this contradiction that sustainable investors want brown firms to care more about the future, but what they're doing is raising their discount rate, which makes them care less about the future. Okay. Now, what about green firms? Well, they operate usually in an industry where no matter what they do, they're still going to have no environmental impact. We have also considered additional incentive effects. I think a powerful thing that sustainable investors could deliver is an incentive for brown firms to become green so they can get cheap access to capital in the future. Okay, this is promising in theory, but what we've shown in the data is that sustainable investors primarily reward firms that are already green for large percentage reductions in their emissions, even though that is not economically meaningful. So I'm just about out of time, so I'm going to forward to the conclusion. One set of results that I didn't get to discuss in detail is one big problem that we see with sustainable investing in practice is there's not sufficient industry adjustment. Okay? There is sector adjustment, but for example, all of agriculture is underweighted by 80%. And we can consume less agriculture and more insurance, okay? So there is some sector adjustment, okay? But there's very limited industry adjustment. So we're not growing the set of firms that can replace critical brown output. So let me end it there, and I look forward to hearing from the discussants.
Thank you so much, Kelly. And I would like to hand it over to Liang from Singapore Management University. Thank you, Hao.
Okay, first, thanks for inviting me to be a discussant for this very interesting paper, and it's an honor to speak in front of this audience. My name is Hao Liang. I'm from Singapore Management University, so let me just give a quick summary of this paper. The key message is very clear. If you direct capital towards green firms and away from brown firms, this can be counterproductive. In order to prove this, Katie and her co-author introduced this important concept, which is impact elasticity, measured as a firm's change in its environmental impact due to a change in its cost of capital. And what Kelly and co-authors show is that a reduction in the financing cost for green firms leads to a very small increase in the impact for those firms, whereas an increase in the financial cost for brown firms leads to a large negative change in these firms. I think this is a very timely and important topic. And there is a very strong economic intuition, and Katie, there is a lot of convincing evidence that Katie didn't have time to show on the screen. Before I came to Tokyo, I read the news that in the U.S. people are protesting again to demand the government to shut down fossil fuels, stop funding them, etc. So my main comments on this research, I summarized them around a few which. And depending on how much time I have, the most important which is which investment strategy, SRI strategy that we are looking at. So as Katie mentioned at the beginning, the dominant sustainable investing strategy is to deprive brown firms of capital and provide green firms with capital. This is essentially a screening strategy. So I got this graph from the Global Sustainable Investment Alliance. This was a little bit outdated. I checked this morning. They still didn't publish the most recent data. So this is up to 2020. Across the world, the most dominant strategy is so-called ESG integration, followed by negative screening. And engagement shareholder action is also a very important strategy. And if you look at ESG integration, majority of them is driven by US investors. Okay, and of course, there are other strategies such as positive screening, impact investing, etc., which are relatively small in their size. So if you think about other equally dominant sustainable investing strategy, for example, if you think about ESG integration, which is about including ESG factors in investment analysis and decision making, then if you think about transition risks or stranded asset risks, those are the risks that brown firms have, and they may be incorporated into the investment decisions into those firms. Or if you think about engagement strategy, or some people call this active ownership. So index investors, for example, they cannot easily divest because they have to invest in index and they have to engage with their portfolio company. How do they engage? They vote favorably on ESG-related shareholder proposals, or they make their own ESG proposals during shareholder meeting, or they try to have an active dialogue with the company's management. Many impact investors who may not invest in public equity but primarily focus on private equity, they also actively engage with their investee companies. So if those strategies are properly priced in, this strategy can also explain the documented negative return and impact relationship, and the large impact elasticity for brown firms. And those strategies can be productive. For example, if engagement is constructive, that predicts higher return over time because the firm improves over time, and also more and more reduction in their emissions. And we probably can see the same results, and this is hardly a counterproductive strategy. I also want to bring up this concept of transition finance, which I think is a hot topic in the PRI. So there's an emerging trend of transition finance, which is about financing that promotes long-term strategic greenhouse gas emission reduction initiatives, such as issuance of transition bonds, transition loans, or sustainability-linked bonds and loans. So the main target of transition finance is to set transition targets and transition pathways in their financial terms in order to promote decarbonization. For example, since early 2017, PRI sets the Transition Pathway Initiatives, TPI, and since 2019, over $18 billion transition bonds have been issued worldwide, largely driven by China and Japan through corporate and sovereign bonds. And although this is still relatively small, but this market is growing exponentially. Therefore, my view is that the issues raised in the paper are currently already being addressed by policymakers, such as those in Japan and China, and financial markets to some extent. And I think this is probably more than sorting greener firms within an industry, as Kelly and Qualter recommended. I think the key challenge in this transition finance journey is on measuring and managing the Scope 3 emission. So let me talk a little bit more about Scope 3 emission, which currently is excluded in the measurement in the paper. So in my own view, not including Scope 3 can massively bias the results and the interpretation. So if you look at the data currently, which only includes Scope 1 and Scope 2 emissions, the green industries are insurance, healthcare, and financial services. However, and as you know, this is PRI, many participants are from asset management companies. Financial services industry has a huge amount of Scope 3 in their downstream because you lend money to the customers and they emit, and those are your Scope 3. And institutional investors, they do care about Scope 3. I have a paper documenting this, and Kruger, etc. Also surveyed large institutional investors around the world, and they do hear the concern from investors that Scope 3 is important. So if you look at this graph across different industries, the orange color is for Scope 1, and yellow is for Scope 2, and the blue is for Scope 3, light blue for downstream, dark blue for upstream. And financial industries, healthcare industries, and probably other industries such as IT, etc., their Scope 3 can account for more than 90% of their total emissions. So therefore, I think when we think about transition finance or depriving brown firms from capital, how do we think about Scope 3 is an important issue. I probably only have time for one more slide. I want to comment on which capital are we focusing on. So I think the mechanism discussed in this paper is mostly for responsible capital, whereas brown firms can be held by all kinds of capital. For example, brown firms, they may be more likely to invest it by traditional capital because they are larger, financially less constrained, and more profitable. And so those traditional capital are also less likely to divest brown firms. So I think an important question is to what extent the impact elasticity measure for brown firms are driven by those responsible investors. To be fair, the authors try to do some tests on whether firm emissions predict its responsible fund holdings, and responsible funds are defined based on their names, whether they contain ESG or green, or whether they are classified as an SRI fund by US SAFE or Charles Schwab. However, as you know, this is a greenwashing concern. Many firms call themselves green, and if you look at their holdings, not too much different from traditional funds. And so my suggestion would be to reclassify those funds based on their ESG ratings of their portfolio companies, or whether their portfolio companies are aligned with more objective taxonomy. So with that, I'm going to skip, and it's a very interesting paper, and I look forward to hearing more about the new findings. Thank you very much.
Thank you so much, Hao. And Hao's discussion will be followed by a practitioner discussion, Andy Harvard. Sorry about that.
Brilliant, thank you. And I'm not using slides. So my brief has been to give a practitioner perspective, having read the paper and having been through it. And I think my sort of key message from it was, you're doing this all wrong. You're making the problem worse rather than making the problem better. And whilst there's a few details in there that we can talk about, that I think, fundamentally it does pose some really interesting questions for us as an industry in terms of how we're approaching sustainable investment and the impacts that we're achieving as a result of that. On the other hand, if we look at this more positively, I think it also really creates a number of opportunities for us to think differently about how we're investing and really how we evolve this question of transition and delivering change over time in a way that is a growing part of the discussion within the sustainable investment industry. I think the focus really is on climate change and carbon emissions. I think the implications probably run slightly broader than that. Whilst that's probably the easiest thing to measure and in many ways the most straightforward measure, that basic principle that a lot of sustainable investment funds focus on companies that are already demonstrating strong performance, whether it's lower emissions or whether it's strong performance across a lot of areas, is a pretty common theme across a lot of sustainable investment. The question in terms of how can we most effectively improve things at the margin, how can investment actually make a change in the real world, is certainly one that we've grappled with and that we look at quite heavily in terms of how we invest. But I think there is a question for the industry as a whole in terms of how we think about sustainability and how we think about good versus bad, effective versus ineffective within the industry as a whole. I looked at similar numbers from the Global Sustainable Investment Association. It's quite hard to break the numbers down, but just taken alone, positive screening or best-in-class screening and negative screening add up to about a third of the total in terms of the value of assets that are being managed in those ways, in terms of the share of overall sustainable investments. I would hope that a lot of ESG integration goes beyond simply saying who's good and let's buy more of those and who's bad and let's buy less of those. I would hope that it's a bit more nuanced in terms of how that's approached for a lot of the industry. But I think that basic theme that there is a tendency to focus on better companies or companies that are currently optically better is certainly fairly common. There's a couple of reasons, I think, that I wanted to touch on. First of all, regulation. I think this has been a challenge, particularly when you're sat in Europe, that there is a real focus on what do companies look like currently. And I would perhaps slightly disagree with the idea of using taxonomies and similar, which really do tend to focus on which companies are already green, rather than necessarily which companies are potentially transitioning and how do we measure the improvement over time for individual companies. And I think that has been a challenge because regulation, so I'm doing it now myself, that it's quite hard to have a conversation about sustainability before you start talking about regulation at some point at the moment. And it is driving and has driven a lot of the agenda over the last few years. I think that might be getting better. The EU, I have mixed opinions about this, but is obviously reviewing SFDR, and the word transition appears in some of those discussions. In the UK, the regulatory proposals also include transition element as well. So this may be changing, but again, I think there has been a headwind and a challenge in terms of how you demonstrate something objectively and quantitatively that is fundamentally a transition over time. The second thing I think is a much broader one and a much more challenging one, which is really around investor education generally. I think if you think about fund fact sheets, if you think about the way that we report on different funds, we tend to focus on the snapshot of what does this portfolio look like today. We all measure, we all look at things like carbon emissions or carbon intensity of different portfolios, how much emission, what are the level of emissions relative to $1 invested or $1 million invested within a fund. What we're not showing, for the most part, is how are those emissions changing. If you put $1 million into a fund, how are the emissions increasing or decreasing over time? And how does that compare to putting $1 million broadly into the market as a whole? And that's the sort of shift, I think, certainly that we're looking at in terms of how we can affect that. But it's not straightforward, and it's not very common in the industry at the moment to really try and understand that change at the margin rather than simply getting exposure to positive areas. And that's not going to be straightforward because it's changing the way that we communicate and the way that we describe sustainability to really, as I think about this, making investing a verb rather than a noun. It's about understanding this is a journey and a transition, an impact that we can have at the margin rather than simply a snapshot of what something looks like currently. And I think my final point really in terms of context is around the role of capital markets, which has changed over the last several decades. We still talk about financial markets, capital markets as being about capital allocation, connecting primary capital to providing that to companies in order that they can make investments and they can do different things. And certainly in equity markets, that's really not true in most of the world anymore. Companies don't raise money from primary markets in the same way that they did 20 years ago or previous to that. And really a lot of what we do is about understanding how can we influence companies to allocate capital differently. If you look at the total, and again, to use the same methodology that we described here, if you look at the companies that are in the bottom quintile, the bottom 20% of carbon intensity in the market represent about 40% of the market's capex. So the ability to have influence on those companies and how they're investing that capex is very significant. And it's those companies where the biggest change can happen at the margin, not just through, where do we provide capital to, but to my mind as well, there's a very important mechanism in terms of how we can influence those companies, given that they typically tend to be more capital intensive. They typically tend to be the companies where that investment at the margin can make the biggest difference. And that's really about stewardship. It's about engagement. It's about using our voice and influence with companies to effect change. And so I think, whilst there are a lot of challenges highlighted by the analysis, that conclusion, as I say in my very simple read of this, we're making the problem worse by shunning the brown companies and focusing on the green companies, that actually when you net it all out, the effect in terms of negative impact on the brown companies and the volume of emissions that we could be influencing is much bigger than the green companies. Is a very significant one, and it should make us all think, I think, about how are we constructing sustainable investment portfolios, how are we analysing sustainable investments, and how are we developing products that are part of that transition, and how do we demonstrate that transition to our clients in order that we can better understand what we're trying to achieve. And I look at it, personally very positively. I think that transition question is becoming increasingly important for a lot of the industry. I think we've all got an opportunity to think about how we look at this differently. I've got some questions, say similarly, about the approach in terms of the extent to which sustainable funds are having an impact on costs of capital. I think there's been quite a lot of studies, for example, looking at the effects of divestment on cost of capital, which are at best quite mixed, but certainly don't demonstrate that divestment outright from certain activities has a very significant impact on most of those companies. But nonetheless, we are whether we're impacting the cost of capital or not, we're not part of the solution to how we can engage and influence those companies. And certainly, I do believe, and this is more of an anecdotal view than anything else, that as investors, we can have an influence on management teams, we can have an influence on companies. Long-term investors can make a difference by being long-term invested in companies to make long-term investment decisions themselves. There is a lot of academic studies that look at the relationship between long-term shareholders and long-term investment decisions by companies. And I think we have an opportunity to be part of that and to think slightly differently. It's not straightforward, but there's enough, I think, to the point that was made at the very beginning. The dominant investment strategy is buying green companies, low carbon companies, and selling brown ones. I hope that the industry is more nuanced than that. Certainly, we don't need as many people as at this conference in order to simply rank things according to carbon intensities and buy the ones at the top and sell the ones at the bottom. So there's a lot of expertise, a lot of thoughtfulness about how we drive that change. And I personally see this as an opportunity for us to think about how can we demonstrate the role and influence of managers in terms of driving that transition over time. So I thought a brilliant paper, really made me think, and thank you very much for producing it.
And thanks so much for sharing your thoughts with us. Thanks so much. Before we move on to the next paper, may I just ask Kelly, any reactions to the discussants?
So first, thank you to my two discussants for really thoughtful, helpful comments. And I'll just take like 20 seconds to just introduce one issue, which both of you touched on. So I think it's great that it's clear that sustainable investing is moving toward more nuanced, thoughtful strategies. One problem that I see, though, is there's this growing push toward we want to minimize carbon transition risk. Okay, and I think that's a rational desire, but the way to minimize carbon transition risk in your portfolio is also to underweight polluters, even if they're transitioning, right? But by underweighting high pollution firms, we're also continuing to raise their cost of capital, which ironically increases their carbon transition risk. So I think that's just it is a more sophisticated strategy, but it's also a problem if that's our only goal, to minimize carbon transition in our risk in our portfolio.
Thanks so much. Thanks so much again for an excellent paper and for the very thoughtful discussions. I would like to move on to the second paper and to that discussion. Then at the very end, hopefully we'll have a couple of minutes left to have a thoughtful conversation about both studies, okay? And let me introduce you to Matilde Faralli, I hope I pronounce this correctly, from Imperial, and congratulations again for being awarded, I should not say winning, but rather being awarded a well-deserved Best PhD Paper Award. Okay. Matilde?
Thank you. Yeah, thank you, the organizers, for including my paper and for the award. So I'm a fourth-year PhD candidate at Imperial College London, and this is the paper, What Drives Beliefs About Climate Risk, Evidence from Financial Analysts. So the motivation of the study. In the US, the total cost of natural disasters from 1980 to 2022 are approximately 2.2 trillion US dollars. And given the current trajectory of global warming, we know that these costs are expected to rise in the near future. In Japan, and this is just to give you a sense of how much climate change plays a role in this cost. In Japan, climate change was responsible for 40% of the 10 billion damages from Typhoon Hagibis. And this is from a study from researchers at Imperial College and Oxford. From the academic literature, there is a fast-growing and recent literature that highlights that market participants react to climate-related events. And I'm bringing here 3 studies, but there are many more, and you might be aware of them. So in these studies, the first is of my discussant today, Darwin, Choi, and co-authors. And after an extreme heat wave, investors sell high carbon footprint stocks. The second study from Anderson and Robinson shows that Swedish households are more likely to change their pension choices after these extreme heat waves. And the third study shows that mutual funds managers change their portfolio allocation across industries. And this is from Alex and co-authors. So you all have one key point. You have an extreme weather events, in this case are heat waves, but there are many more studies that use other type of extreme events, and then you have a change in behavior. So what I do in my paper, I study how equity analysts, they change their earnings forecast after extreme weather events. So I'm not only looking at heat waves, but I'm using a more broader definition of salient weather events, and I'm looking at many different types of events. So the questions that I'm trying to answer is, how do experiences of weather shocks affect beliefs about climate risk? And to do so, I built a dataset with geolocalized analysts in the US and natural disasters. I'm not going to get into the details of the methodology, but the key point is I have treated analysts, and these are analysts that are within 100 miles from an extreme weather event. And then I have my control analysts, and these are analysts which are more than 100 miles from these weather events. And the control analyst will be my counterfactual for the treated analyst. And then ideally, this analyst should forecast the same firm. And this firm should not be affected by the weather shock. I don't always have this exact match, so I will try to keep at least firms in the same sectors for the control and the treated analyst. And the main takeaways are, I do see the analysts, they change their forecast, but are they actually learning something from experiencing these weather events? And it seems that only very high-skilled analysts are able to maybe extract some sort of information about climate risk from these events. So the conceptual framework, to make you understand better how I think about this forecast, imagine there is an analyst that makes a forecast for a firm. And I divide this forecast in two parts. There is what I call the information set, which is the top part. And these are informations that analysts can just go outside and take all this information. For example, firm sales and costs, suppliers, macroeconomic factors. And I make a very, very strong assumption that the weather events does not affect this. So that's why I try to use firms which are far away from the weather shock. And then I claim that the event only affects the analyst because it's only located within 100 miles within the analyst location and affects the climate beliefs of this analyst. So in the dataset, I have IBES forecasts, and these are annual forecasts from 1 to 5 years horizon. I have analyst location, and these are analyst office location. Unfortunately, I don't have information before they start working as analysts, so this is a limitation of the study since I try to use first-time treated analysts. And then I have climate events, and I include all events which satisfy one of these three criteria. They have 10 or more fatalities, 100 or more injuries, or greater or equal than $1 billion total economic damages. And then I have firms information. I use the headquarters as the firm location, and I do a series of robustness tests with other type of business location of these firms. And then I have the typical CRIS CompuStat information, and also have true cost climate physical risk for these firms. So the result is analysts, they become more pessimistic and more accurate after experiencing this event. So pessimism is calculated using forecast bias, which is the earnings that an analyst make minus what is the actual earnings of the firm divided by the stock price in the previous period. And we see that the forecast bias goes down, so they become more pessimistic, and then they also become more accurate. So the forecast errors also goes down. That is similar to the bias, but the numerator is in absolute terms. So it's how far away these analysts are from the real, like the actual earnings of these firms. And then I collect as much characteristics of these analysts as possible. So for example, for a subset, I have their political donation, I have the gender, I have, of course, where they're located, so I know if it's a place which is more or less climate sensitive. And I see that this result seems to be constant across many different characteristics of these analysts. I also repeated this analysis for different sectors, and I see that this seems to appear especially for sectors which we will associate with high climate risks. So for example, transportation, manufacturing, construction, and agriculture. And then I try to understand, are these analysts learning something from this event? And it seems that analyst performance is a key characteristic. So in this case, what do? I ask this question. If, for example, I'm an analyst and I experience a hurricane, am I becoming pessimistic for all firms or firms which have very high hurricane risk? So in the first part, I'm looking at firms which have high physical risk as the shock that the analysts experience. And you see here that both the high performance analysts and low performance analysts, they become more pessimistic, so the bias goes down, and more accurate, so also the error goes down. But then when we look at firms with low physical risk as the shock experience, you see that here it's different. You see that the high performance analysts, actually they become more optimistic and the forecast error doesn't seem to change, while the other analysts, they just become pessimistic. And this seems to hold for other set of results, that these low performance analysts always become more pessimistic, showing maybe more a psychological effect, like they get traumatized by this event and then they just become pessimistic and then they revise the forecast down. And because on average, these analysts are over-optimistic, anything that brings the forecast down makes them more accurate. And so the main takeaways from the study, so analysts, they become more pessimistic yet accurate after experiencing these weather shocks. I didn't show here, but in the paper I also look at types of different weather events. So I look whether are events with very a lot of health-related damages, so a lot of injuries or fatalities, and or events with very high economic damages. And again, we see that low-performance analysis seems to become mostly pessimistic, especially for health-related damages, so which are more traumatizing in a sense. And the high-performance analyst seems to become more pessimistic for events with high economic damages, in a sense that if we can learn something from these weather shocks, maybe learning about the future economic cost of climate change, economic damages will give us more insights. And to conclude, the policy implication, of course, given the results of the paper so far, we should enhance communication about climate risk, especially for less skilled analysts that might not be able to extract information from it, and for regions with fewer climate-related events. And so this is a work in progress, so any comments or questions are well accepted. And thank you.
Thanks so much, Matilde. Yeah, hand it over to the academic discussant, Darwin Choi from CUHK. Thank you, Darwin.
Thank you. So thanks for having me here. It's a great paper. I really enjoy reading it, and congratulations on the well-deserved award. So my name is Darwin Choi. I'm from Chinese University of Hong Kong. So I want to compare this paper with some other papers that focus on the stock market, right? So as Matilde mentioned, right? And I highlight the unique contribution of this setting when she looks at the analysts. So some papers look at the stock investors. So for example, they find that investors sell brown stocks after experiencing some extreme weather events or natural disasters. There are multiple explanations for this, right? So one is that investors believe that brown firms in the future will have lower cash flows. So the cash flows are lower, more pessimistic, or the returns, the future returns are lower, or the risk will be higher. Now, these don't have to be correct. These are the investors' belief, right? So they believe that holding brown firms will give them a lower benefit than holding green firms. So that's why they can sell the brown firms now and prefer holding green firms. So that's one explanation. There is another explanation based on preferences. Now, investors can believe that holding brown firms can be better than holding green firms now. But even if the benefits perceived to be higher, they still prefer to hold green firms, right? So for example, they are socially responsible. They have, as economics call it, a utility function by holding green firms. So despite the lower returns offered by the green firms, they still prefer to hold green firms. Now, empirically, it's very difficult to differentiate between these explanations. So there are different types of beliefs investors can think about. We cannot really ask them how they make up the decision of selling brown firms, right? So they also can have preferences, okay? So it's very difficult to differentiate between these explanations. Now, what is very nice about Matilde's paper is when she focuses on financial analysts, it looks like she can claim that this comes from the analyst's belief, right? Because analysts now issue more pessimistic forecasts after experiencing the natural disasters. Whereas the analysts, the main job for them is to predict futures earnings, right? So the firm's future cash flows, right? So it looks like the analysts here, they think that firms' cash flows will be lower. They don't really predict returns, they don't predict risk. Their main job is to predict the earnings, right? So we can now nail down it is about the beliefs by the analysts about the future cash flow, right? So it's also not because of their preference, right? So normally they actually have a preference to do the other way around. So they have a preference to issue more optimistic forecasts because sometimes they want to please the firms to maintain the relationship, right? So but here they're issuing more pessimistic forecasts, right? So it looks like these don't really come from preferences and also more focusing on just one type of beliefs, right? So it's about the future cash flows. So something that I hope Matilde can highlight better in the paper. So because what that really differentiates between your paper and the existing literature. Now, I also want to make a comparison between her findings and the existing findings, right? So for example, my paper with Zhenyu Gao and Wenxi Jiang, we show that retail investors sell brown firms after experiencing abnormally warm weather. We find that institutional investors do not react to the abnormal temperatures, right? So we argue that retail investors are less sophisticated. Retail investors suffer from limited attention. They normally don't think that global warming is happening. They think about it when they feel it, when the weather is warmer than usual. So the warm weather is a wake-up call. Okay, so if we think about the findings by this paper, the findings suggest that financial analysts behave more like retail investors. They are less sophisticated, right? So think about a really super smart, well-informed analyst would already know and understand climate risk, right? So like he or she doesn't have to react to the natural disasters, especially the natural disasters don't even affect the firm that he or she is following, right? So like the perfect, smart, well-informed analyst would not react to this, right? So like the institutional investors. So I hope I don't offend anyone in this room. If you are a super smart analyst, you should not react, and you are the exception. If you react to the events, you are human. So I also want to emphasize these disasters do not contain information about the firm, right? So throughout the paper, Matilde uses the term information hypothesis, which I think should be more careful with, because these are not really information. And in fact, in my paper, we argue that local temperatures are more noticeable, but they contain negligible information about the global trend, right? So if you think about the global trend, we want to limit the average temperature to be like within 1.5 degrees Celsius, but the local weather, like today, has very little information about the long-term global trend. Okay, so it's not really about information, right? So I'd rather call these personal experiences or wake-up calls. But these are good, right? Because in general, what we think is analysts, and like many financial market participants, generally underestimate climate risks. So we also know from the finance literature, non-local analysts, so analysts that are located far away from the firms, are less informed than the local analysts, right? So they behave worse in terms of the forecast. Now, the disasters that struck the analysts now actually provide an opportunity for the analysts to learn and to become better. Now, the paper shows that high-performing analysts use these experiences and the wake-up calls correctly. They reduce the degree of underestimation and information disadvantage, right? So they bring it closer to the perfect, like, smart analyst. Now, the low-performing analysts don't. They actually overreact in some cases, right? So like in some cases, they overcompensate for this, and then they increase the error. Now, I think it is crucial to differentiate between high-performing and low-performing analysts. So this seems to be a critical part of the paper. So I hope Matilde can like conduct a few additional checks to make sure this definition is robust. Okay, so in the paper, high-performing analysts is very like defined standard. In the standard manner, right? So analysts are ranked within their respective firms based on the forecast error, right? So she also adjusts for the size of the firm, the number of analysts that are in the firm, right? So the resulting rankings give an individual performance score for analysts within a year. And then the high-performing analysts are defined as those who have a high score over the last 3 years. Okay, so these are very standard. Now, my question is, can there be some selection issues? For example, if high-performing analysts are assigned stocks that are easier to analyze, for example, large stocks, or in their portfolio, typically they follow 8 to 10 stocks. In their portfolio, they follow stocks in the same industry, right? So making their job easier, right? So then it's not surprising that exposed, right? So their forecast errors are lower, right? So this assignment might matter, right? So, or if the low-performing analysts, since they are doing a poor job, they get their portfolios reshuffled, right? So this year you analyze 8 stocks, and then next year you analyze 8 different stocks. Okay, so making their life very difficult. Okay, so I hope to see whether this will have some a selection issue. Right? So a quick check for her is whether high and low performing analysts portfolio stocks are similar before the event, right? Before the shock, right? So you can like compare their portfolios. And a related question is, after the shock, can actually some analysts drop firms? So like, let's say they're too depressed after the natural disasters, they stop following the firm, they stop issuing the forecast. So how do they show up in the paper? How do they show up in the sample, right? So because when you don't forecast, then you don't have a forecast error. So I have a last comment that I will pass to Matilde offline. So it's about the physical risk versus the transition risk. But overall, it's a very, very interesting paper, and congrats on the well-deserved award again, and good luck with the paper. Thank you.
Thanks so much, Darwin. And last but not least, I hand it over to Martin Skancke. You stand in between the audience and the lunch, so no pressure.
No pressure. Okay, I'll be super quick. So thank you for interesting and award-winning paper. So I think it's for me natural to start by thinking about, well, why should we care about what analysts think? What role do they play in the financial system? So to me, it's important to start by recognizing that they are part of the price formation process in financial markets. And we should think about this in the context of what financial markets are for. They're for allocating capital to productive uses. And we want capital to be allocated to productive uses and not tied up in business models that are not compatible with a low carbon economy. And so that requires market participants to correctly assess climate-related risks and opportunities of companies to ensure that these are reflected in these companies' cost of capital. And I think Darwin Choi raised exactly the right question, which was asking about what is really the informational content of these extreme weather events. And to me, that leads to the question of implications for companies and their communication policies. And it's natural for me, as also one of my other sort of hats is I'm a member of the Task Force on Climate-Related Financial Disclosures. And we came up with a reporting framework for climate-related risks for companies. A central element in that was stress testing, and that companies should stress test their business strategies against both physical risks and transition risks. And so I think a natural question is then, would implementation of the TCFD and now the ISSB S2 framework give analysts access to better and more standardized disclosures that would make it less likely that analysts are swayed by events that are not necessarily relevant for understanding risks associated with individual companies? And so I think an interesting future paper would be to look at how analysts, whether there are differences in how analyst expectations are formed, depending on the quality of the disclosures that companies have made on stress testing their business strategies. And it's also, I think, reading this paper, I guess, reflecting on a sort of deeply human trait to generally overreact to news, which is, there's a large literature on behavioral finance, and it'd be interesting to hear also whether you've made some comparisons with studies of how market participants react to other news. Is this a climate-specific issue, or is it just a specific instance of a much more general issue of how we as human beings react to news and how that feeds into valuations in financial markets? So I'll just stop there in the interest of time, but thank you so much for an interesting paper.
Thanks so much, Martin. Matilde, may I ask, do you have any immediate reactions?
Yes, I think to the last point, yes, definitely. I tried in the paper to also look, so there is a very interesting paper which looks at terrorist attacks and how analysts they react to this attack. And actually, I get very similar results. So I don't see that they react, again, when I divide by firms with different climate risk. I don't see this difference for high performance analysts, but in terms of magnitude, it's very similar. So it seems like when there is some very strong negative events, we kind of always react in the same way. But yes, and I also want to thank Darwin Choi for the useful comments, and yes.
Great. Well, thank you for a great paper. We magically have a couple of minutes left for Q&As at the very end. And I see a hand up. Yes, please. If you don't mind stating your name and affiliation.
Kylie from UBC. So my question is to Kelly. So maybe one potential solution is those brown firms also change their mix of financing by seeking from like issuing green bonds and also on the credit side. So because that also have implication to cost of capital. That I know it's beyond your paper. Do you want to comment on that?
Yeah, so I'm very supportive of both project-specific financing for green R&D, which is growing, as well as just more thoughtful, nuanced screening to reward the set of companies that are transitioning. Maybe their level of pollution is still high, but they're making meaningful progress. But it's not obvious, in my opinion, that the debt market is more sophisticated than equities. There is a lot of sophisticated green debt, but there's also this huge push now for kind of non-targeted banks to completely divest from various fossil fuel portfolios. And then the question is, well, somebody's still going to own those fossil fuel assets. Would they necessarily manage those assets in a greener fashion than the previously possibly better managed public company?
We could essentially stop on time, but what's the fun of it, correct? So let's take one more question.
Okay, I'll start. So my name is Marius. I'm from...
That's all right.
Oh, someone...
That's all right, please. Go ahead.
Okay. Marius from... That's right. One thing I would be... one thing I'll be interested for people to do more research on is what happens when you have demands for high environmental standards for companies like mining companies that produce copper. How does that slow the transition? Because we need copper to electrify our grid. So I quite like to see more research around that. Because if you now have 5 extra years for getting a permit because you have high standards of ESG demanded from investors, how does that slow the transition?
I think this is directed to Kelly, correct?
Yeah. So I would just generally encourage more consequentialist thinking rather than, I feel like it's a lot of sustainable investing, the origins of it were deontological. So the idea that it is wrong to associate and reward any company that does bad stuff, right? But we do have to think about the consequences of this, which is suppose copper is relatively high polluting, but it is part of the supply chain eventually for very useful green technology. Then we really need to actually think about possibly supporting this industry and thinking about kind of in aggregate, what does this do to the environment?
Yeah, and the problem is that carbon emissions don't take that into account.
Right.
So yeah, I think more research there would be great.
Okay, last question for the lady in red.
I feel like everyone should go to lunch. I can touch base with Matilde offline.
All right, great. All right, with that in mind, thank you.